Last but not least, we have Tracy Benjamin, founding partner of Osprey Equity Partners, which is a real estate investment and development specialist focusing on the food store and hotel sectors. Tracy is going to talk to us about the commercial property outlook for London and the regions and the appetite from investors for different sectors of the property market. And just in case any of you are worried about the time, we've had a slight change of plan. We will do the questions at the end informally over coffee. So, thanks, Tracy.
Thank you, Georgie. Good morning, everybody. Yes. Outlook for commercial property in the UK. Well, the commercial property sector has been performing exceptionally well in the UK market. The UK commercial property sector was up 17.9% in 2014, with a prediction for next year of slightly less growth, probably because although we have continuing low inflation, low interest rate environment, imbalance between supply and demand still in the London market. The UK is a very small island. We have very limited availability of good quality property. That drives up demand, particularly in rental growth in central London, as we'll see in a moment. And it's a long-term hedge against inflation. So looking at the London market, it's a very unique sector. London has unique drivers in supply and demand. The London market was up 28.2% in the last 12 months. That was the London retail market. The London central office market was the second best performer at 23.5%. And that was basically based on substantial investment in the UK sector as a whole. There was an investment of 62 billion in the UK market, of which 42 billion was invested in London alone. London holds particularly trophy assets, the prime area where most of the institutions want to invest. 70% of the money invested last year in London came from overseas buyers, which is quite a staggering statistic. Also, there's no obvious short-term value in London. London is seen as a long-term destination where people like to retain their asset. It's a trophy asset, and they like to hold those assets for the long term. Looking forward, rental growth is driven by tenant demand. So in London, in the retail sector, you're looking at yields of 2% in prime retail in Bond Street. In the areas such as Oxford Street, you're looking at yields of 3%. And for offices in London, you're looking at slightly better returns of maybe 4%. So why is London attractive? It's attractive because it's a secure destination. It's a destination where overseas buyers and institutions feel comfortable that long term, on the basis that tenants take leases where rents can only go one way. They can stay the same, but they can only go up. They can't go down. Typically, tenants take medium to long-term leases. Leases on average are over the entire market is about 5 years, but also lots of tenants take leases of 10 and 15 years, which gives that long-term security of income. London was the second destination investment for most of the institutional buyers, just behind New York. Looking at the regions also performed very well. In fact, industrial property was the third best performer in the UK at just over 23% in the regions. Increased appetite, especially from UK institutions, seeing less value in London and the South East. That value is now moving out to the regions. More opportunity for active management, more opportunity to work those rents, and that's why industrial investment was probably the third best performer, because there's really good scope for rental growth and for active management. More availability of stock, more choice, but the attractions of the regions is certainly an area where we can see significantly more investment going into the outside of London and the South East, where there's little value, and most people look to buy because of their intention to hold investments for the long term, and where in the regions you get that more active opportunity to increase value. Investor appetite. We see investor appetite continuing. We see London continuing and the UK to be a destination where the institutions as well as the high net worth family office and the high net worth individuals are looking to invest their funds. We see the attractions of the UK commercial property market being the security of the covenant. A lot of investors that we talk to, that's their primary objective. They want the security of covenant and they're prepared to take lower returns as a consequence. The longevity of income, the security of a long lease is particularly attractive to the investors that we talk to, the high net worth individuals and the family office clients. They have the same attitude and approach. It's the security of income and the longevity of income. Typically our investors are looking for leases of not less than 20 years, and 25 years is also quite normal in some of the asset classes that we're involved in. Defensive assets. We see commercial property in the sectors that we're investing in as a very defensive asset. It's part of a long-term portfolio, but those assets are designed to give people that long-term security and attractive risk-adjusted returns. Returns are driven by rental growth and capital appreciation. Your rental growth comes from tenant demand. It also comes from knowing that every 5 years there will be a review of that rent based on the open market value. The investors we talk to typically are looking for more certainty in that market. So what we typically are involved in is assets where the rents are geared to inflation. So either CPI or RPI is the driver. So you know that if there is inflationary pressures, your rents will go up in line with inflation, and it acts as a long-term hedge against inflation. And for the institutions and those investors looking for the long term, it creates a guaranteed increase in the rent so long as there's an uplift in inflation. Creating and looking for value. It's quite hard in the UK market to look for instant value. So the approach that we take is slightly different in identifying value. And value can be created through long-term holds, through open property funds, which provide more liquidity, but you can also invest in direct commercial property, owning your own assets. So whether you're a family office client or you're a high net worth individual, the attraction of knowing exactly what you're investing in is, for these clients, particularly key. The difference between high net worth individuals and family office clients is predominantly control. Family office clients like to know that they're in control of the asset, whereas high net worth individuals are very happy to invest in an institutional asset on the basis of getting real value. So how do you obtain value? Well, value can be obtained in a number of ways. One way in particular is working with developers who have already secured a site, they've secured planning, but they actually don't have the money to build the property. So the approach that we take is to work with them to create that value, to use our investors' funds, sometimes with debt, sometimes without, and by doing so we're getting an immediate benefit. We're buying a new property, that property has the benefit of a long lease, minimum typical term is 20 years. There is the benefit of capital allowances. Talking from a tax perspective, those allowances significantly reduce the tax that you would pay on rental income, and the discount that you would typically gain is anything up to 10% of the value of the asset when it's built. So on the basis that the leases are linked to CPI and RPI, you get inflation-linked leases with long-term tenants, and on the basis that you're looking at target returns of 9 to 11% IRR, compared to what the overall market has done this year, which is an IPD index, as I said, of just under 18%, you're sacrificing some degree of return for the benefit of longer term security and having the element of control. In terms of looking ahead, we see commercial property being an asset class that the institutions, high net worth investors and family office will form as part of their ongoing portfolio. We don't see the UK market performing as strongly as it's done to date. General consensus is that returns will ease back. Of that 17.9% this year, 12% of that was capital growth and the balance was income. We see this year returns being somewhere in the regions of 11 to 12% on a sort of basket across the whole of the index. There will be obviously hotspots in different areas that will perform better, but we still see London as a destination where high net worth individuals and in particular overseas investors will still continue to invest because they see it as a long-term secure hold, whereas the rest of the UK potentially offers more value, but certainly UK institutional property is an area where we see continuing appetite and growth. Thank you.